Shares of Paramount Global, they are moving higher this morning. Take a look at where that stock is, up about 3%. The company reported better than expected profits and revenue. Paramount also reaching a deal to sell its book publisher, Simon & Schuster, to private equity giant KKR for $1.6 billion. Joining us with more, Tom Rogers, former NBC cable president, former TiVo CEO, and a CNBC contributor. Good morning to you, Tom.
Good morning, Andrew. Good to see you.
What do you think of these earnings? And we've started to see an uptick, I think, both in the stocks and frankly, a bit of a turnaround in the businesses of a number of these streamers.
Well, this was a very different tone than Bob Iger took in his CNBC interview. This was not legacy is much worse than we thought it was, and we have to sell and partner our way out of this. This was much more, we have great programming. We have many windows to exploit it through, including a lot of licensing. The legacy business, we think, will get a bit better on the advertising side. The streaming path we're on is fine. They're clearly doing the best they can with the hand they've been dealt. It's not a great hand. It's hard to argue that Paramount on its current path is going to have the scale it needs to overcome the legacy media business decline that it's facing. But clearly there was some progress here.
Tom, is your sense long-term? I mean, I think there's all of these folks in media land that have this chessboard in front of them, and they think to themselves, long-term, there's going to be lots and lots of consolidation, and yet nobody wants to make the first move, in part because they're scared that this administration, from an antitrust perspective, would block a transaction. Do you think that's the right way to think about this? Because the other piece of it is that if you really look, there are so many now chess pieces on the board that it may be a hard argument for the government to make and win.
I agree with you, Andrew. Look, the government lost the argument that the AT&T acquisition of Warner was going to be anti-competitive, and the dynamics for the legacy media business have worsened terribly since then. I don't think it's so much antitrust concern. There's some unique concerns about broadcast licenses and being able to combine certain of the broadcast assets. But I think it's much more a question about who wants to double down with such secular declining assets, with cable fees declining, and that decline going to accelerate with declining advertising revenue, with declining viewership, with debt loads hanging over these legacy media companies.
But then what do you think the right answer is? Does it become private equity? I mean, we just saw KKR buy Simon & Schuster, which, by the way, it's a cash-free, it generates a lot of cash. These are still businesses that do that.
Right.
They just don't get the multiple because they don't have the growth.
But book publishing, I wouldn't argue, is in secular decline. It's not a big growth business, but it's growing and it's generating cash, and it faces different dynamics than traditional TV assets. I'm not sure there is a great answer there. Certainly, consolidation allows you to take out significant costs. Paramount is doing some of its own consolidation, saying it's saving $700 million with the Showtime integration into Paramount Plus. But beyond some one-time cost savings, it's not clear that there's anything about those kind of consolidations that's going to accelerate growth, particularly on the streaming side. And as a result, I think everybody is somewhat cautious that that is necessarily the best answer.
All right. At these valuations, we've got Netflix, Paramount Global, Walt Disney, Warner Brothers Discovery, and Comcast on the screen right now, Tom. I don't know if you can see it. Is there a stock here at this number that you would actually want to own?
Well, the only one that isn't burdened by legacy media decline, and I've been talking about this for a long time, is Netflix. It's one thing when you can just focus on streaming growth. It's another thing when you're half in to streaming and still trying to manage a legacy business, trying to manage where else you sell your programming beyond your own streaming service. And I think there's a real question, can you be half into the streaming business and still drive substantial success? And I think all the other companies still have to try to prove that. Netflix, on the other hand, has a clear growth path ahead of it and is obviously highly cash flow positive already on the streaming side and can take advantage of that cash to continue to drive its competitive place relative to the others.